Welcome traders. This is Mel with High Speed Trading Company, and this is the market efficiency paradigm. It's lesson 1 of the High Speed Trading Academy. We are going to go into what the market efficiency paradigm is to give you a broader understanding of why it's important, why you need to know it. Basically, everything that we're going to work on in this course is going to be built upon this foundation. And this is the concept you need to understand to be able to utilize and best be successful in the market. We know that about 90% of all traders will fail. They'll blow up their accounts literally within the first year of trading. That means only 10% of them make it. So why do those 90% fail? If trading is so easy, we come into this trading and we think, oh, I'm gonna learn this. This will be easy. I'm good with numbers. I'm good with finances. I'm gonna learn this. And we jump in there, and within a year, 90% of us are broke. So this is the foundational. This is the cornerstone of what these concepts that we're going to teach in this course are built on. The objectives in this course today, lesson 1, is to understand the idea of the market efficiency paradigm. Who are the players within this market efficiency paradigm? How the market efficiency paradigm performs its function, and the key to understanding the market efficiency paradigm. So basically what we have here is we have two pools of money. We've got smart money and we've got speculative money. And trading is a zero-sum game. For every loser, there's a winner. So if 90% of the people are losing money in the market, somebody's getting that money. And typically it's going to be smart money because they understand this model, they understand this concept, they see the big picture, and they know how to use this to their advantage. Speculative money, uninformed money, another thing you can call it is dumb money, is they don't know. They don't know how to do it. They get in there and they look at supply and demand. They look at support and resistance. They look at Fibonacci. They look at Elliott waves. They look at all these different things that the books they read tell them how to trade and be successful in the market. But yet, as many books that have been written on trading, 90% are still losing within the first year. So there's 3 types of traders. We have commercial traders, non-commercial traders, and non-reportable. That's what the commitment of traders, it breaks it into 3. And we'll talk about the commitment of traders in a later lesson. But right now, we need to understand that basically there's 2 kinds of money: smart money and dumb money. Smart money is your central banks, your large financial institutions, your governments, retail. Your dumb money is individual traders, hedge funds. The average hedge fund, by the way, exists 7 years before they go defunct. We have banks and insurance companies. Doesn't mean that dumb money is always going to lose. It just means they don't understand some of these concepts and they fall prey to the paradigm of smart money. So, how do they do it? One of the key ways they do it is with the interbank price delivery algorithm, IPDA. We've all heard the term high frequency trading. Those trading computers use algorithms and they use programs to transact a large number of orders in a fraction of a second. When I trade, I'm trading with 1, 2, 3, 10 contracts at the most. Maybe on a good day with the big account, I'll trade more. These companies are trading trillions of dollars a day. And they have a lot of orders they have to fill. Because it's a zero-sum game, for every seller there has to be a buyer, and for every buyer there has to be a seller. And this algorithm creates an environment that the smart money can fill their positions before they go and take the market to where they want to take it to. That's the key right there. This algorithm creates an environment that is conducive to the smart money to take positions in the market to where they want to go. So the interbank price delivery algorithm, they're liquidity providers. They're the market maker, smart money. They control price delivery. The IPDA facilitates the opportunity for smart money to work in their positions at key strategic levels and capitalize on the move that the IPDA is going to deliver. And we'll show you some examples of this, but very simply, if the market is down, they're going to create an environment where they can fill their long positions, and that means there has to be sellers selling in those positions before they can take in the market long and capitalize on the move up as the market moves up. Without the IPDA, the markets would be random. And as you go through this, as you learn to trade, as you learn these concepts, you'll begin to understand how this is not random. And this works to our benefit. And the reason it works to our benefit is if it was random, we couldn't have certainty on where the market's going to go. We couldn't have certainty how the market's going to act. But because it isn't random, we know how the market is going to act, how it's going to work, and how we can use it and trade like the smart money trades. We must understand that there is a method and a rhythm behind the delivery of price. This gives us the confidence that markets repeat themselves every day. They don't only repeat themselves in every day, they repeat themselves in every market. Every market traded in the financial industry, in the commodities industry, they all work under this algorithm, and they all work basically the same way. They may have different nuances between them. You know, the NASDAQ trades a little different than the ES, but they still work under that same algorithm, and they still operate and perform the same way, and they still are predictable in the same way. Markets are engineered to take money from the uninformed. So the first thing we need to understand, which is key, is very, very, very key to the algorithm, is it works on liquidity. They need a big pile of orders. You know, if they're going to fill a $1 trillion, or let's just say several $1 million or $1 billion worth of orders, and they need long orders, they need to find a position within the market where they can fill those long orders, and they've got to have sellers on the other side. So what they do is they move the market in such a way that they can fill those orders, and then the market is going to move in such a way to be able to profit from that. See, the market only does two things. It reprices higher for buy stops or to rebalance a premium inefficiency. And two is it reprices lower, that's wrong there, I got that wrong, prices lower for sell stops or to rebalance a discount inefficiency. So they're looking for buy stops, or they're looking for sell stops, or they're going to rebalance to an inefficiency. So let's look at this example. What we have here is a market, and we're just going to look at a couple things here. If you were going to participate in this move up right here, the algorithm understands and knows that most traders are going to place their stops right down here. So the market goes up, Their stops are here. The market works in such a way that as it goes up, it then begins to go down. It takes out those orders, and right here, it fills them. And in this case, it's going to take them long. And then the other example is here we got the market going down into a discount inefficiency. The market goes down, orders are filled right here. It takes the market up, and we see there's buy-side liquidity right here. It takes that and fills that, takes that and fills that. And we'll talk a little bit later about premium and discount. This is just a broad concept right here. Then we will get into this more and more and more as time goes on. Stop hunts. Stop hunts are locations within the market where the algorithm fills their large orders before moving in the other direction. Before any significant price run, there will always be a run on the opposing liquidity. These stops hunts allow smart money traders, the liquidity providers, to position themselves for their target. And stop hunts reject the liquidity pool aggressively and displace in the opposite direction. So two things we need to understand, and we'll go into this in the next few lessons. Number one is the draw on liquidity, and where we find liquidity, where the market finds liquidity before it takes it to that draw on liquidity. So if you were to look at this example, we got the market going down, and it turns. For some reason, let's just say there's either an inefficiency here, or maybe it took another stop hunt from a previous low. But as the market goes up, these traders are all going long. And as they go long, the market begins to go short. And now here, bang, it takes out all these traders, all these stops. And now they have this big pile of orders that they were able to fill to be able to drive the market up to the draw on liquidity. So knowing where the draw on liquidity is key to your success as a trader. Here's a bullish example of a market. We see the market coming down here, kind of comes back up, comes down, takes out this low right here, stop hunt. After it takes out stop hunt, it aggressively moves up, and then till it goes up to the buy side. And therefore they're going to then either take it higher and reverse it, which they did here, or they're going to take it higher and continue up. Another lesson. But here they take sell side liquidity, and here they're taking buy side liquidity. A bearish example we have here is the market. They take the market up, bring it down. So these people are jumping in the market here, going short. They put their stops, because if you're short, you then become a buyer. They put their buy orders up here. As the market goes up, takes them up, and then it quickly goes back down to a draw on liquidity that is somewhere down here. And that's it. That's a very simple basics to the paradigm that we need to understand. We need to understand that the system's rigged. It is rigged. You may not totally buy into that right now, but you will as time goes on and you begin to look at the markets in more detail. The other thing is, because it's rigged, it works off an algorithm, and that algorithm is a pretty thing when you begin to understand how it works, and you can begin to predict with high accuracy of where that market's going to do, what it's going to do, the time it's going to do that. And all these things are lessons that we're going to learn as we go forward in this academy. So until the next lesson, I want to say be blessed, and we'll talk to you soon.